Second important topic that we have taken today is prompt corrective action framework. Prompt means fast or early. Corrective means we all know to apply some corrections. Action framework. So why this is in news? Because recently Central Bank of India may soon exit the restrictions of RBI's PCA framework. The PCA framework is issued by Reserve Bank of India. We'll be dealing with what is PCA framework and why is Central Bank of India going to exit it. What happened was Central Bank of India was put under the PCA framework by RBI because of the some kind of risk exposure of the some specific certain kind of risk exposure of the specific bank. What happened was, but now Central Bank has made some improvements into its finances, right? And it seems to be doing good. After that, Central Bank of India actually made a representation to RBI and said that the PCA framework for us should be removed because we have been doing fine. Let's have a background at it. The PCA framework was applied in 2017 due to its high net non-performing assets (NPA) and low return on assets. So we can clearly see that these two things can be a trigger for RBI to put certain bank under the PCA framework. One important point is PCA framework was earlier only applicable to the banks. Now after the last year, the collapse of these IIFHL, Indian Institute of Housing Finance, Indian Institute Housing Finance Limited, and all these specific banks in housing sector, there was some problem with the banks. DHFL, so due to that they were NBFCs, they were not banks, right? But they were so big that their collapse or a poor condition of these NBFCs also led to ripple effect in the economy. It led to ripple effect in the economy. So RBI, to counter that kind of effect again, what they did was they brought the NBFCs also under the PCA framework. That is prompt corrective action framework. Now this whole framework deals with the aim of this framework is to limit the lending activity of the bank, to limit the exposure of the bank, to limit the risk exposure of the bank in case the bank is not doing fine. The Central Bank of India may soon exit because there is an improvement. How? Because it reported 234.78 crore profit in the first quarter of this fiscal year. The profit rose by 14.2% as compared to 205.8 crore in the same quarter last year. So they are riding high on this improvement, and they then said that the bank's gross NPA has reduced from 15.92% to 14.9% in the latest quarter, and net NPA also saw a decline from 5.09% to 3.93% in this quarter. That means their NPAs are falling, their profits are growing. What is return on asset? Now for a bank, what is an asset? It's a very conventional question. I have asked it many times in my lectures. What is an asset for a bank? What is a liability for a bank? An asset for a bank is the loan that it gives out to people. An asset for a bank is the loan it gives out to people. Now asset banks are what? Financial intermediaries. Financial intermediaries means Wait, let me change the background to white. Okay. Now I believe it is visible properly. Now banks are what? Financial intermediaries. Okay. What they take? They take in deposits. They take in deposits. What they do? What they do is extend out loans. Now, when the bank takes deposits, it has to pay this deposit back. Pay this deposit back to the person who has deposited his money. In addition to that, he has to also pay certain interest. Okay. The deposit can be time deposit or what? It can be time deposit or a fixed like current account. Okay. Time deposit means a deposit which will be redeemable after a certain point in time. But the current accounts are on demand. Demand deposit or time deposit. Demand deposit means a person who has deposited his money, he can take the money out anytime. Okay. But for fixed deposits, the person can take out the money only after certain specified period of time. Okay. So in this case, the bank will have to dole out some money regularly in form of interest. But in case of loans, right? In case the bank has extended loan to someone, what will happen is they will be getting some kind of interest, okay? Interest on that. Plus, this loan will also be repaid back to the bank. Okay? So this loan will also be repaid back to the bank. So this is the expenditure of the bank. Okay? And this is the asset of the bank. This is the asset of the bank. So I hope you understood the difference between asset and liabilities or expenditure. Deposits are liability of the bank because they have to be paid back. Okay, whereas loans extended by the bank are asset of the bank because they pay them they pay the bank interest and also they will be paid back to the bank. Now return on asset. We were talking about return on asset, right? So what happens is if the bank has extended some loan, okay? So let's delete this. If the bank has extended some loan to someone, okay, for example, the bank has extended loan to government and the bank has also extended loan to people like Malya, okay, people like Malya. In both the cases, there is always a risk that the person will default. The interest premium that bank charges depend on the risk of the person. It is very important to understand. This is a very basic banking concept that, see, these are the loans. Let's write it down. These are the loans. Okay. The bank has extended to government and Malya. Both the loans have a certain degree of risk. Okay. Both the loans have a certain degree of risk. Okay. Now bank will charge a higher interest to which of both of them? So the amount of risk will be reflected into the interest payment that these government or the Malya will make to the bank. Why? Because the higher risk investment that it makes has the higher chance of being defaulted upon, or there might be a chance that the person who has taken the loan, he might never actually return the loan back. Okay. In that case, to cover this risk, what the bank will do, the bank will charge an interest rate higher than what the bank will charge to the government. Okay. This will be greater than this. And this reflects what does this reflect? This reflects the amount of risk involved with this person. Okay. That means the interest premium is a reflection of the risk involved in lending out money. Now, this loan became an asset for the bank. which extended to Mallya or the government. In both the cases, that will be considered an asset. There can be one important consideration, however, that the riskiness of asset can be different for both of them. The riskiness of asset can be different for both of them. Okay, and if we give some specific value to the risk, okay, risk, if we quantify risk, if we put risk into some number, okay, so if the government's risk is 10%, Malya's risk will be 50%. That means if we consider one risk-free, that is, for example, 0% risk. Okay, if this bank makes an investment that is having 0% risk, that is, if the bank is keeping the money with itself, okay, so it will be having 0% risk, but it will be having 0% return as well. Okay, but if the bank, instead of keeping the money with itself, loans out to the people, that means it is taking certain kind of risk. And if it is lending to a lesser risky person, it will charge a lower interest rate, because the interest premium is a reflection of risk. Similarly, if the person is charging higher interest rate, or the bank is loaning out to a person who is having higher chance of defaulting upon, the risk is higher, then the interest premium will also be higher. I believe you have understood. In this case, since the risk is low, the return on asset, that means what return the bank is getting on the asset means loan. In the case of government, it will be high, because governments are stable, governments are regular payers, like governments, the chance of defaulting by the government is low, right? But in the case of Mallya, there is a high risk, and therefore return on asset can be low. It is not always low, of course. It can be low in case Mallya defaults on its loans. Okay, and if he does not pay the interest or the principal for continuous 3 months, then it will be considered as NPA, that is non-performing asset. Okay, so let's get back to, right. So it has the return on assets. The return on assets are like due to high net performing assets and low return on assets. Okay. What is a prompt corrective action framework? In 2014 or 15, I believe, the governor of RBI, Raghuram Rajan, he conducted an asset quality review. Asset quality review means he started checking the bank's the bank's balance sheets to see if their assets or the loans they have extended are functioning well or not. In that, he found a large number of banks, almost all the public sector banks have had a great amount of NPAs. Okay. NPA means the bank's extended loan, people are not paying the loan back. So, prompt corrective action framework was actually introduced in 2002. Okay. But after the asset quality review of 2015, in 2017, prompt corrective action was revised based on the recommendations of Financial Stability and Development Council on resolution regimes for financial institutions in India and FSLRC, Financial Sector Legislative Reforms Commission. These two bodies made some specific recommendation with regard to the huge size of poor assets with the public sector banks. These two committees made some recommendations to bring about some change in the PCA, Prompt Corrective Action Framework, and those recommendations were included into the new PCA framework, which was originally brought in 2002. And what PCA does is, if RBI senses that some bank is not performing well in terms of its return on asset or in terms of its if NPA is increasing, okay, there are some kind of risk thresholds that RBI has set, and if the bank breaches that risk threshold, then the RBI imposes some kind of restriction. This whole process is called prompt corrective action framework. Now let's see what are the specific risk thresholds. Okay, so CRAR, right? CRAR. Okay, these are the limitation indicators or the risk thresholds. If these risk thresholds are breached by the bank, okay, so depending on what kind of risk threshold the bank has broken, okay, or breached, there will be some kind of punitive action imposed upon the bank, right? These are the punitive, not corrective actions, okay, and these are the limits of what kind of breach is allowed or what kind of breach should be limited. So CRAR, so whenever we talk about CRAR is what capital adequacy ratio or capital to risk weighted asset ratio. Capital to, let's look at what this whole CET1 NNPA negative ROA, let's look at what is this. I'm talking about there is a risk threshold that should be CRAR should be less than 10.25 and greater than or equal to 7.75. But if this falls below this value, then certain kind of other, that means if CRAR falls, okay, then the risk factor increases. Let's look at to how this all functions. Okay. Okay. Okay, CRAR, capital to risk weighted asset ratio, or it is called capital to risk weighted asset ratio. The name itself is very self-explanatory. It is a ratio, first of all, it is a ratio, okay, or it is also called CAR. It is called capital adequacy ratio. Now, what is adequacy? Adequacy means sufficiency. Do we have sufficient capital or not? Right? Do we have sufficient capital or not? That is all adequacy. Now, when we talk about CRAR, it is a very simple ratio. CRAR or CAR is equal to tier 1 capital. Okay, I'll be explaining all this. Tier 1 capital plus tier 2 capital. Okay, tier 1 capital plus tier 2 capital upon risk weighted assets. Now, first of all, look at what this risk weighted asset is. And what this CRAR is. Okay, CAR for Basel norms, if you follow the Basel norms, Basel norms are specific norms recommended for the banks and NBFCs to be followed. What are they? They are what this whole CRAR actually is. We have seen the formula. CRAR means if a bank is doing lending, okay, again bank is doing lending, so he'll be lending to a lot of people. The bank will be lending to a lot of people. Okay, so for example, Adani, okay, Ambani, because these people are the major loan takers, right? Not me and you. Malia, okay, and for example the government itself. If the bank is loaning out to these 4 people, so the kind of risk involved with every person will be different, right? For example, if we set 1% as the standard, and Adani, if 1% represents zero risk, okay, so Adani represents 15% risk, Ambani represents 10% risk, for example, Mallya represents 80% risk, okay, government represents 5% risk, okay. And now if we see how much of money the bank has loaned to every entity, okay, how much money the bank has loaned to every entity. So for example, if this person has 100 crore, okay, this person has 100 crore, this person has 100 crore, and this person has 100 crore. So total asset size will be 10, 20, 30, 40. That is 400 crore. The total asset of the bank will be 400 crore because 100, 100, 100, 100, 4. The bank has loaned to 4 people only and 100 crore to everyone. Now what is the risk weighted asset? Risk weighted asset means how much of this asset is actually risky asset. That will be calculated by multiplying this factor. 5% means 0.05 into 100, okay, 0.05 into 100 means 5 crore, then 80% into 100 means 80 crore, फिर 10% into 100 means 10 crore, and then 15 into 100 means 15 crore. Let's write it down, it's very interesting actually. 15 plus 10 plus 80 plus 5, okay. So how much it becomes? 15 plus 5, 20, 80, 100 and 10, 110. That means 110 crore rupees is actually risky asset. That means the size of 110 crore, that if the total size is 400 crores, okay, if the total size is 400 crore, out of this asset size, 110 crores is very risky. 110 crores rupees is risky. That is, the retrieval of this 120 crore rupees or 110 crore rupees becomes difficult for the bank. Okay. And if this risk weighted asset size increases, like that means that shows the risk associated with all these lendings is increasing. Like if it becomes 30%, if everything becomes 30% except for Mallya, which becomes 80%, then of course this value increases. Right? If this value increases, that shows the bank is actually lending to such people where the recovery of the loans becomes very hard. The bank has to reduce this. But one important point is this cannot be reduced to zero. This cannot be reduced to zero. When bank is lending, it is certainly taking some kind of risk. But also lending to people with 80% risk is not very financially prudent thing to do, right? What should be done is they should lend to people who are having lesser risk. That means the chances of recovery of the loan is higher. That is, the asset is actually a performing asset. Okay. Now, if the bank, now let's coming to the tier 1 and tier 2 capital. Okay. What is, as I said in the very beginning, CRAR is tier 1 capital plus tier 2 capital, okay, capital upon risk weighted assets, tier 1 capital plus tier 2 capital plus risk upon risk weighted assets. Now what is tier 1 capital and what is tier 2 capital? Again, to understand this, let's look at the diagram again. Bank, okay, this is the bank, right? Tier 1 capital and tier 2 capital. Bank is having two kind of capital. Now asset is different. Asset size is the loan extended to people. Capital, on the other hand, is the amount of cash that bank has, or the amount of money that, or the amount of earning the bank has. Okay, right? So it can be considered from the very simple example, like if a person is having 10 lakh rupees in his bank account, okay, and he has extended 50 lakh rupees loan to someone, so this 10 lakh will become his capital, right? His capital, right? And this 50 lakh will become his asset. Okay, of course capital will be a part of asset, but the asset we are talking about here is loan, the loan extended to the person. I hope you understood this example. So let's remove this. Okay, and again back to, for example, this is a bank, okay, and this bank has extended rupees 100 crore. And this bank has its own earnings and savings. Every bank is a financial entity. So earning plus saving, okay, everything, the bank like people, it has around 1000 crore. If the bank has earning and saving of around 1000 crore and the loan, okay, capital will be low, okay, and anyways, I hope you understood this. Earning plus saving is 1000 crore. That is the capital of the bank. That is, it is its own money, earning, saving. That is the capital of the bank. And then comes the asset. Asset means the loan extended to people. I hope you understood this. Now again, let's get back to tier 1 capital and tier 2 capital. When the bank goes into liquidation, for example, liquidation means the bank runs out. The bank is being closed. So when the bank is being closed, who are the people who will be given their share for the first priority? The first priority will be given to whenever any institution is liquidated. Okay, so the first claim on that entity comes from debtors. DEBTORS. Debtors means the people who have given loan to that specific financial entity. Like if the bank has run out, the people who have given loan to the bank, they will be having the first claim on the bank. तो अब ये समझने की कोशिश करो कि when the bank has run out, that means if its earning and saving has exhausted, right? So in that case, if all its earning and saving is exhausted, so what will happen? Where will the debtors go? To ensure that debtors money or debtors claim is returned, every bank has to put certain kind of money in its tier 2 capital. Tier 2 capital. Okay? So that is tier 2 capital. It is not very liquid. This capital is not very liquid. Okay. And this is used to reimburse the debtors. This is used to reimburse the debtors in cases where there is a bank run. When there is a bank run, right? This money, tier 2 capital, is used. The size of tier 2 capital is smaller than tier 1 capital. But this tier 2 capital is used in cases to return the debtors money. Okay. So I hope you understood the tier 2 capital. Tier 1 capital is total earning and saving of the bank minus tier 2 capital. That will become tier 1 capital. Okay. In the very basic terms. So if the total earning and saving of the bank is this, and what proportion of that earning and saving is the risk the bank is taking, that is called capital adequacy ratio. Capital adequacy ratio. That means capital adequacy ratio is the capital of the bank to the risk weighted assets. The capital of the bank to the risk weighted assets, as to how much money do you have versus how much risk you have taken. That is called the capital adequacy ratio, and this capital adequacy ratio has to be maintained at least 8% as recommended by Basel norms. Okay, the CAR for India is 8%, but RBI recommends it to be 9%. Okay, higher than that. That means RBI says that no, 8% is low, you have to maintain higher capital adequacy ratio. That means you have to put higher capital, so that that means the capital to risk weighted asset ratio should be high. Okay, should be high, yes. That means the amount of risk weighted asset you have should be low. Okay. Okay, I believe you understood this. Capital tier 1, tier 2 capital, risk weighted, okay, asset, right? So that is what tier 1 and CRAR. So CRAR should be between, the RBI recommends it to be standard be 9%, but if it falls between if it is less than 10.25%. But if that ratio starts falling, CRAR starts falling, that is, if it falls below 7.75%, it falls below 7.75%, then what we have to do, that means you have breached the risk threshold too. And if it falls below that also, then you will be put on a certain different part as risk threshold 3 is. Okay. Similarly, capital equity, common equity, tier 1 capital. Tier 1 capital should be also a specific portion, as you can see, which should not fall below this. Net NPA ratio. NPA means non-performing assets. Non-performing asset means any loan that has been extended and either the principal or the interest on that loan has not been paid by the person who is taking that loan for at least 3 months. So that kind of loan will be considered NPA. Okay, net NPA should be, if it is less than 9%, so it is threshold. But if starts increasing, so it is a breach of limits. Okay. So, and negative ROA means return on asset. Negative return on asset means if you have extended some loan and your interest are not getting back. Okay, so that is considered negative return on asset. For 2 consecutive years, for 3 consecutive years, for 4 consecutive years, these are the risk thresholds. So you don't have to remember everything, but what you can look for is the CRAR. That is the most important point to note here. Okay, and what is the Basel norm recommendations for CRAR and what are the RBI recommendations? Now, if we breach the risk 1, okay, if we breach the risk 1, what happens is restriction on dividends. Dividends mean the shareholders get dividends. Okay, shareholder get dividend means the people who are shareholders of a bank or a company, when the company makes profit, so what it does is it extends dividends to its shareholders. Okay, more capital for foreign banks. Discretionary action by regulator. The RBI can put some more restrictions. If you breach the risk threshold 2, so of course restriction on branch expansion can take place. This is a very important point. Restriction on branch expansion. Higher provisioning norms. Provisioning norms means now the bank will have to separate a greater part of its capital into the T1 capital and T2 capital rather than extending that capital as loan. Okay. So discretionary action by regulator, of course. And if the risk threshold 3 is also broken, so restriction on dividend, branch expansion is stopped. Okay, restriction on management compensation, the management will not be able to take higher compensation. Restriction on director fee and discretionary action by regulator. Means RBI can take any other action which it deems fit. So let's look at the Basel norms, because we have been talking a lot about the Basel norms. Okay. So Basel norms were actually introduced in 1988. There's a Basel Banking Committee which decides all the specific leverage ratios, capital adequacy ratios, as to what kind of capital the bank should have with itself to protect a bank run situation. Okay. Introduced in 1988, CRAR should be 8% of the risk weighted asset ratio. Okay. It should be CRAR should be 8%. India adopted Basel I guidelines in 1999. Then came Basel II in 2004. It has 3 pillars. See, Basel I norm had only one pillar, that was CRAR. That is credit riskiness of the credit. But Basel II had 3 norms: CRAR, supervisory review, and market discipline. Okay. So these were what? These were qualitative. Supervisory review means what kind of management the bank is having. Okay. And what kind of market discipline that specific market is having. Okay. So in that case, Basel II norm along with CRAR 8%, Okay, so along with the quantitative CRAR of 8%, it also came up with the supervisory review and market discipline. That is, these two are what? Qualitative, the qualitative disciplines that were imposed upon the banks. Basel II norms are not yet completely implemented across the country. After that came Basel III norms. These were introduced in 2010. after the subprime mortgage crisis of 2008 to 2010. Okay, it has 4 parameters and it is very detailed. The capital adequacy ratio should be 12.9, minimum T1 capital should be 10.5, and minimum T2 capital should be 2%. See, as I said in the very beginning, the T2 capital is lower than the T1 capital, because T1 capital is the major cushion, that takes that is used by the banks in case of bank run or liquidity crunches and everything. But T2 capital is used when the bank runs out. The bank run has happened. Now the debtors are to be paid back. The people who have given loans to the bank, they have to be paid back. Okay, these people are reimbursed from this T2 capital. Okay, leverage at least 3%. Leverage means what is the total capital and how much is the total asset size of the bank. Total capital versus total asset size. Now one can get confused. See, in one of as I talked here, you can see the total capital of the bank is 1000 crore and the bank asset size is 100 crore. Okay, if we found out the ratio of 1000 crore to 100 crore, okay, so it comes out to 10%. Okay, the total capital of the bank and the total asset size. If we reverse this, so it becomes 100 by 1000, which becomes 0.1. Okay, 100 by 1000 becomes 100 by 1000. Okay, ये it becomes 0.1 into 100 is equal to 10. Okay, 10%, and this becomes 10% when this is like 100 crore. 100 crore is its total capital. Now let's take a new slide. Right, we are trying to understand what is leverage. Okay, where CRAR is total capital T1 plus T2 upon what? Risk weighted asset. Here one important point to note here is CRAR represents only risk weighted assets, whereas leverage shows the total capital plus capital, total all the capital that bank has upon all the asset size. Okay, plus upon all the asset size. Now let's take two scenarios. Okay, if the total capital of the bank, the total earning of the bank is 100 crore, okay, and the asset size, the bank has extended loans of up to 1000 crore, so it becomes 10%. Okay, 10%. Whereas if this one 10,000 crore is what? Total capital, and 100 crore is only 100 crore is it asset size. Okay, then what happens is 10 into 100. Okay, that means the total, the bank has extended loan or asset 10 times its total capital. 10 times its total capital. Okay, in this case the bank has extended only one tenth of its total capital as loan. What I'm trying to say here is bank, okay, if a bank has extended 10 times, if the bank has extended loan 10 times its total capital, that is the first scenario. And the second scenario is if the bank has extended 1/10 of the loan of the total capital as loan. In which of the both cases the bank is more safe? In which of the both cases the bank is more safe? Of course this, because the bank is still having 9/10 of its capital with itself. But in this case, the bank was only having 100 rupees and it extended 1000 rupees loan. Okay, if none of the people give its loan back, so it will be facing a loss of 1000 rupees. Okay, in this case, if the bank is having 1000 rupees and it is only extending loan of 100 rupees, then the bank will only facing the what? The loss of 100 rupees, which is only 10% of this one. So this exposure, this ratio of total capital of the bank to the total asset size, not only the risk weighted asset, but the total asset size, is called the leverage, as to how much a bank is leveraged. So that should be at least 3%, at least 3%, it can be greater than that. Okay. Funding and liquidity. Banks need to hold buffer, because the banks during the subprime mortgage crisis of 2008-9, they did not have a lot of buffer of high quality liquid assets. Okay, due to which they were not able to maintain the liquidity and bank run happened. The Basel III norms were to be adopted by India in 2019, but due to the COVID, the adoption has been extended. It has not been adopted yet. So I believe you understood this very important, very interesting economics topic. If you have any doubts, reach out to me. I'll be more than happy to take it.